Are you self-employed, own your own property, or you're a real estate investor and you're trying to access equity from your property, but when you went into the bank to inquire about getting a home equity line of credit or a second mortgage, you were told, sorry, you don't qualify? Not to worry, there is a solution. In this episode, we're going to cover how to utilize the NonQM HELOC or HELOAN so you can access equity from your property without touching your first mortgage. I'm Ryan Marks, host of SEI Podcast, and we are dedicated to those of you who are self-employed or property investors and providing loan solutions so you can purchase a home or build your real estate wealth. In today's episode, we're going to unpack HELOCs and HELOANs in the non-QM space so you can access equity in your property without tax returns, W-2s, or pay stubs. This is another great non-QM product that's going to allow you to access equity in your property without touching your first mortgage. You may have a very low interest rate on your first mortgage, but you need to access cash in your home, whether that's for home improvements, consolidating debt, you're looking to purchase another property and want to take equity out as the down payment for another home, or whatever the reason may be, but you have a low interest rate on your first and you have all this equity that's accrued in your property on your primary residence, second home, or even investment property. Good news, you can access equity in your property even if you've tried to get a home equity line of credit or a fixed second mortgage from the bank, but you weren't able to qualify because you didn't meet the debt to income ratios based on what the qualifying income was that you were able to earn. Before going into the non-QM HELOCs and HELOANs, let's talk about what the qualifying criteria looks like in the QM space or qualified mortgage. So if you were to go into the traditional bank or lender that's offering a home equity line of credit, they're going to use what your gross adjusted net is on your tax returns after any deductions or write-offs that you've taken. That income then is going to be used to calculate your debt to income ratio. Another thing that's important to mention is the debt to income ratios are often stricter when you're qualifying for a home equity line of credit, meaning if you're using a qualified mortgage and the debt to income ratio can go up to 50%, oftentimes, depending on the bigger bank that you're using, debt to income ratio could be as low as 43% or even 36% in some instances. So what that means is the amount of outstanding debts that you have, including your existing first mortgage with your taxes and insurance, all of those numbers added together divided by the amount of qualifying income that you have is going to leave you with a percentage. If that percentage exceeds that 36 or 43%, or maybe 45 in some instances the banks will go up to, you can't exceed that number. Unfortunately, there's typically no exceptions on that. So on top of likely having lower qualifying income in the QM space, you also have stricter debt to income ratios, making it more difficult to qualify. So in addition to that, pro tip, the bank's not going to use the payment for the home equity line of credit that you're making. So most home equity lines of credit offer an interest-only payment, meaning if you're taking out funds and utilizing your home equity line of credit, when you make the minimum monthly payment, it's likely covering only the interest to the bank. So if you have a $100,000 home equity line of credit and you have $50,000 that you're utilizing, that minimum payment on a monthly basis is only going to be interest only. So you're not going to be paying the balance of your home equity line of credit down unless you apply more money towards the principal balance to actually pay that down. So there are advantages to that though, because it's giving you a lower monthly payment and you do have the ability to pay more at any given time. But because it's set up as a home equity line of credit, it's essentially a variable line of credit. So the pros of using a home equity line of credit are, if you have a $100,000 home equity line of credit set up as a second mortgage, but you're not using it and the balance is just sitting at zero, well, then you're not making monthly payments on that available line of credit. But it's immediately there if you want to draw on that home equity line of credit. So the bank is going to calculate whatever the outstanding balance is on any given month and essentially divide that by 12, and that's going to determine what your monthly payment is. So all of those nuances with the home equity line of credit are available on a non-QM HELOC as well. But the way we derive your qualifying income is much different than a QM mortgage. Instead of using your traditional tax returns to qualify your home equity line of credit or your second mortgage, we're going to use other forms of documentation. That could be 12 or 24 months of your bank statement. So in previous episodes, how we calculated the bank statement income for purchasing a property will be the same way that we calculate your income for a home equity line of credit. We're going to take an average of all your deposits earned through your profession and then apply an expense factor to give you what your qualifying income is. So for example, if you have $100,000 in deposits and we applied, let's say, a 10% expense factor, that would give you $90,000 in qualifying income divided over 12 would be used to determine your debt to income ratio. So just like the QM home equity line of credit, the non-QM home equity lines of credit still follow a debt to income ratio. However, the debt to income ratios are often much higher on the non-QM HELOCs. Some of these home equity lines of credits will allow up to a 50% debt to income ratio. On top of that, you're likely going to see much more qualifying income available to you, which would further reduce your debt to income ratio, so you wouldn't have to worry about going up to that 50% threshold. You also have to consider your credit score when qualifying for a home equity line of credit in the non-QM space as well. There are minimum thresholds to the lowest FICO score requirements available, but they are much lower than the traditional QM home equity lines of credit as well. So let's look at an example of how you would access equity on your primary residence. So you own a home, you're self-employed, you have a mortgage on your first home, but you have equity in your home that you want to access to consolidate debts or maybe purchase another property. So we would take 12 or 24 months of your deposits on income earned, and then we would apply the expense factor associated with your profession, or if you have a CPA or tax preparer that could provide us with what your expense factor is, that's how we would derive your qualifying income. That number would then be divided out by 12 to give you your monthly income. Then we would take all of your existing expenses, so your minimum credit card payments, any student loans, your vehicle payment, and your first mortgage payment to include your taxes, insurance, and any homeowners association dues. And then we would take what the qualifying interest rate would be on your home equity line of credit. And for the interest rates associated with the home equity line of credit, they're actually very comparable to a standard QM home equity line of credit because they're taking into consideration your credit score and your loan to value and your property type and your occupancy type. You can still receive a very competitive interest rate on a HELOC even though you're qualifying using the bank statement loan product. Some of the other major differences with the non-QM HELOC is, aside from qualifying with a lower credit score and higher debt to income ratios, you can also go much higher on your loan to value of available equity that you have in your property. To give you an example, a home equity line of credit on a QM loan won't go above 80% on a primary residence, meaning if you own a home, it's worth $1 million, and you owe $800,000 on your first mortgage, you're at an 80% loan to value. You can't access that additional 20% equity. They don't have 100% loan to value home equity lines of credit or even fixed seconds in the QM space. But the non-QM space, you can actually go up as high as 90% loan to value on your primary residence. In addition to that, if you own a rental property and you want to access equity in your rental property, typically the QM home equity line of credit is not going to go above 65% loan to value, where in the non-QM space, you can go up to 75% loan to value, and there's even investors that we work with that will allow you to go up to 80% loan to value on an investment property. So you can access all of this equity that's available in your home and do so using the non-QM approach. So aside from the primary residence, let's say you own an investment property and you want to access equity in that property. You can use the 12-month bank statement loan to access the equity in your rental property, but in addition to that, you can actually utilize the DSCR loan as well to gain access to equity in your property. So in previous episodes, the DSCR loan, or the debt service coverage loan, it qualifies simply on how the property performs. How much rent are you receiving against what your mortgage payment is, including all of the taxes and insurance, would be the same method to qualify for a cash out fixed second. Typically, this type of product isn't available on the home equity line of credit space, but you can still access it on a fixed cash out second. So what that means is if you took out $100,000 from your rental property, it would be similar to a standard fixed mortgage on your first, meaning that at the end of the term, whether that was a 10-year all the way out to a 30-year term, would be fully paid at the end of that term. If you accessed $100,000 in equity and you made the minimum monthly payment for 30 years, that loan would be fully paid off and that equity would be back in your home and you would no longer have a mortgage associated with it. But why that's so powerful is because you're using no income documentation to qualify to access equity in a rental property, which you cannot do at all in the QM space, right? If you took a second mortgage out, you would still have to provide your tax returns, and the bank is going to look at all of that rental income listed on your Schedule E, and if you're reporting losses on those properties, even though that property is very profitable and you're seeing that money go into your bank account every single month, you're not able to use that income because you took advantage of the tax deductions available once you reported it on your tax return. And just like the DSCR loan when purchasing a property on a first mortgage, there's no debt to income ratio whatsoever. You're just meeting the credit requirements and does the property cash flow. If you're making $1,000 in rent and your combined payment, including your first mortgage, is $1,000 or less, that's typically debt coveraging, and that's what the investor needs in order to qualify to access that cash out. So this is huge. I mean, if you think about what you can do if you're trying to build a real estate portfolio and you've used, let's say, the BRRRR method, which we're going to cover in future episodes, where you're buying a property, you're renovating it, you're renting it, and you're repeating it, you have a way to access your equity that you've built from renovating that property, and now it's worth more money, or it's worth what the fair market value is. So this is huge. If you're trying to build a real estate portfolio, you can use the DSCR fixed second to access equity in the property if you use the BRRRR method. So there's so many reasons why having a home equity line of credit can be a powerful tool. In all my years of lending, I've had numerous conversations with clients on all of the great advantages there are about having a home equity line of credit. So not only is it used to build additional wealth or consolidate bills, but just acting as a safety net, right? So for example, if you had damage in your home and had to file an insurance claim, there's been situations where you're waiting on the insurance company, but you need to fix the problem that happened. Maybe you had a flood or a leak and you don't want mold in your home, and you need to complete these repairs while you're waiting for the insurance company to pay you. Well, if you had a home equity line of credit, you could access that cash in order to fix the damage while you're waiting for the insurance company to reimburse you for the claim, right? Or you're a self-employed business owner, and there may be times throughout the year where your business isn't generating as much income because it's maybe seasonal, or you're just in a lull, or whatever the reason may be. Well, rather than trying to take out a personal loan or a business loan, you can access that home equity line of credit while you're waiting for your revenue to increase, and then simply pay back that home equity line of credit and leave the balance at zero until you need it again. There's so many reasons why having a home equity line of credit on your property can give you peace of mind, just knowing that you have access to those funds when you need it. If you can't qualify for that home equity line of credit and access all of that equity that you've accrued by appreciation, what use is it if you have to redo your first mortgage and lose potentially your low interest rate? And typically when you're taking cash out of a property, the interest rate's higher on a first mortgage versus if you're just doing a rate and term loan. So HELOCs and fixed seconds in the non-QM space are just another great product that's available for self-employed borrowers or property investors to allow you to gain access to the equity in your home and use it as a vehicle to put you in a better situation financially or further build wealth. So if you're self-employed or you're a real estate investor, now you have a solution to access the equity in your property in order to build wealth or put yourself in a better financial situation. And if you want to learn more about the HELOCs or fixed seconds, head over to SCImortgage.com, where we have additional information about these great products and tools and resources available to you. Thanks so much for joining, and remember, let your money work smarter, not harder.